Today we're doing something practical. Case studies. Not the glossy, victory lap kind. The ones where a deal almost falls apart, but where a great sale turns out to be a headache a year later. We're talking small and mid-sized businesses, and we'll cover sales, mergers, and acquisitions. What went right, what went wrong, and what you can steal for your own playbook.
And to be clear, we're not naming real companies. But these are all scenarios we've seen repeatedly in the market. Patterns that show up across industries. If you're a founder, an operator, a would-be buyer, or someone who's just curious how deals work below the billion-dollar headlines, this is for you.
Let's set the frame. When SMB deals fail or succeed, it's usually not because someone got fancy with spreadsheets. It's because of four things: price expectations, deal structure, diligence surprises, and integration, or the lack of it.
Also, the human element. Owners are selling their identity. Buyers are buying risk. And both sides tell themselves stories that may or may not match reality.
All right, case study 1. The too good to be true e-commerce brand sale. Picture a direct-to-consumer company doing about $5 million in annual revenue, strong social presence, and a couple of hero products. On paper, it looks like it prints money.
The seller markets it with clean charts, revenue up and to the right, gross margins that look healthy, and a neat ad backlist. A buyer comes in, small private investor group, wants to close fast because they're afraid someone else will grab it.
They do lightweight diligence, bank statements, Shopify exports, a quick inventory count, and a few calls with the seller. The buyer offers a strong multiple with a smaller holdback. Everyone feels good.
Then post-close, the buyer learns the secret. The growth was heavily driven by paid ads that were already saturating. Customer acquisition costs were rising. The seller had been using short-term discounting to keep volume up. And the recurring customers. Not as recurring as they looked, just people responding to promotions.
So the business didn't collapse overnight. It just deflated. The buyer realized their pro forma, assumed the past would continue. But the past was partly a paid illusion.
What could have saved them? 3 diligence moves. 1. Cohort analysis. Are customers coming back without discounts? 2. Channel concentration. How dependent are you on one platform or one ad account? 3. Operational reality. What happens if you stop pushing promotions for 60 days?
And from the seller side, here's the lesson. A business is more valuable when growth drivers are durable. If your growth is mostly turn the ad knob, the buyer will either price that risk in or they should.
Case study 2. A blue-collar services company with an owner who did everything. Think plumbing, vac, electrical, one of those. Solid reputation, about 2 million EBITDA. But the owner is the estimator, the rainmaker, and the relationship hub.
A regional competitor wants to acquire them. The pitch is synergy. Combine dispatch, consolidate suppliers, keep technicians busy year-round. The buyer offers an attractive price, but they include an earnout tied to revenue and customer retention.
The seller agrees, thinking, I know these customers. I'll help for a year, and then I'm out. Here's the issue. There's no real plan to transfer relationships. Customers trust the owner, not the logo.
In month 3, the owner tries to step back. Customers start calling his cell directly. The buyer pushes work through their system, changes pricing a bit, changes scheduling, and introduces new policies. Some customers drift.
Then the earnout becomes conflict. The buyer says, we paid for your revenue stream. The seller says, you changed everything and chased them off. Everyone feels cheated.
This is a classic earnout trap. Earnouts can work, but only when the metrics are controllable, the governance is clear, and the integration plan is aligned with the earnout period.
So what would good look like here? First, a structured transition plan. Joint customer meetings, scripted handoffs, and a timeline that changes how customers contact the company without making them feel abandoned.
Second, redefine the earnout. Instead of pure revenue, tie part of it to specific actions. Onboarding milestones, key account retention, or documented relationship transfers. Third, clarify who decides pricing, staffing, and marketing during the earnout. If the buyer controls the levers, they also control the outcome.
Case study 3. The strategic merger that sounded great in a slide deck. Two professional services firms, say, marketing agencies or IT consultancies. Each does about 3 to 7 million in revenue. They're complementary. One is strong in enterprise sales, the other is strong in delivery.
They decide to merge as equals. No one wants to feel acquired. They announce the merger. People celebrate. The founders promise cross-selling new capabilities and career growth for the team.
Then reality hits. Compensation systems don't match. One firm pays higher base salaries. The other leans on bonuses. One firm has strict time tracking. The other is loose. One firm sells custom projects. The other sells retainers.
And the founders? They never agreed on who is CEO in practice. So decisions slow down. Leaders start lobbying. Teams start comparing notes. Wait, they get what benefits?
Client experience gets messy. A client hears 3 different answers depending on which legacy team they talk to. And cross-selling, the thing they were sure would happen, doesn't happen because nobody owns it.
This one doesn't always explode. Sometimes it just quietly underperforms for 2 years. And then one side buys out the other, or key people leave.
The fix is boring but effective. Decide governance before the press release. One operating system. One leader with final say, even if there's a shared board. Align the sales motion and delivery standards. And define the first 90 days like a project with owners and deadlines.
Also, don't call a merger of equals unless you actually build a decision model that respects that. Otherwise, it's just a slower acquisition with more feelings involved.
Case study 4. A manufacturer acquisition where the inventory was the hidden landmine. A buyer acquires a niche manufacturer, steady demand, strong gross margins, decent moat because they've qualified parts with big customers.
The seller's financials look fine. The buyer focuses on equipment, customer concentration, and supplier contracts. They do a basic inventory review, but they don't dig into inventory aging and obsolescence with enough rigor.
After close, the buyer discovers a giant chunk of inventory is either slow-moving, obsolete due to engineering changes, or tied to customers who have quietly reduced orders. On the balance sheet it looked like an asset. In reality, it was future write-offs and storage costs.
And here's the twist. The deal valuation effectively paid for that inventory at close. So the buyer overpaid without realizing it.
The takeaway is simple. In businesses where inventory is material, diligence can't be a glance. You need inventory aging reports, review of scrap policies, customer forecasts, and a realistic reserve for obsolescence.
And in the purchase agreement, you need a clean working capital mechanism. Agree on what normal working capital is. Define what counts as inventory, and include adjustments based on actuals. This is one of those spots where details turn into real money.
Case study 5. The acquisition that went well because the buyer treated people like the main asset. This one is a software services firm. Think managed services or a niche SaaS plus services. The buyer is a larger platform company.
They pay a fair price, not the highest. But they win because their offer feels safer. Clear roles for the leadership team, a plan for career ladders, and a thoughtful integration timeline. They don't try to change everything in week 1.
They also do diligence on culture like it's a financial line item. They ask, who are the key employees customers rely on? What makes them stay? What would make them leave? And then they build retention packages that are simple and transparent.
Post-close, the buyer keeps a brand for a while, keeps the customer-facing processes stable, and slowly integrates the back office. Finance, HR, vendor contracts. Customers experience continuity. The team feels respected. Revenue holds. Synergies show up gradually instead of violently.
This is the reality. For a lot of SMB acquisitions, your biggest risk isn't the product. It's that 2 or 3 people walk out and take client trust with them.
Let's pause and talk about valuations, because listeners always ask, what multiple should I pay? And the honest answer is, it depends on transferability and risk.
If the owner is the business, the multiple should be lower, or the structure should shift toward seller financing and earnouts. If revenue is recurrent and diversified, systems are documented, and the team is stable, you can justify more.
And debt matters. A deal can look expensive on a multiple basis, but still be a great investment if financing is favorable and cash flows are resilient. Or it can look cheap and still be a disaster if cash flow is fragile.
Let's do a lightning round. The most common mistakes we see in SMB M&A.
Number 1, confusing EBITDA with cash flow. If working capital swings hard or capex is real, EBITDA is a starting point, not the answer.
Number 2, weak quality of earnings. If you haven't normalized the financials, you're negotiating off a story, not numbers.
Number 3, underestimating customer concentration. One big customer can be a great anchor or a ticking clock.
Number 4, ignoring the integration plan until after close. If you can't explain the first 30, 60, 90 days, you're not ready to own it.
Number 5, poorly designed earnouts. If the earnout can be manipulated, intentionally or accidentally, you built conflict into the contract.
And number 6, forgetting taxes. Asset sale versus stock sale, allocation of purchase price, treatment of goodwill, these are not details. They can change the net outcome by a lot.
Before we wrap, let's give listeners a simple checklist. If you're buying SMB, ask yourself, can this business run without the owner? What are the top 3 drivers of demand, and are they stable? What's the single biggest operational bottleneck? And what would make customers leave in the next 12 months?
If you're selling, ask, have I documented processes? Can I prove how leads come in and how they convert? Is my financial house clean enough that diligence won't spook a buyer? And am I emotionally ready to hand over control without sabotaging the transition?
Because that's the part nobody says out loud. A deal can be done and still fail if the handoff goes sideways.
Next episode, we can go deeper on one area, like earnouts, seller financing, or how to run diligence when you don't have a giant corporate team. If you want that, think about what stage you're in, buying, selling, or merging, and what keeps you up at night.
That's it for today. Case studies aren't about judging the past. They're about borrowing lessons before you pay for them yourself.